Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Hello and welcome to the latest edition of our Fixed Interest podcast series. I'm Paul Gamble. I'm head of Middle East Africa Sovereigns at Fitch, and I'm delighted to be joined by Cedric Berry, director in the Middle East Africa team. In this episode, we'll be discussing sovereigns from the Gulf Cooperation Council and their economic and fiscal diversification prospects. So, Cedric, what steps are GCC sovereigns taking to diversify their economies and sources of fiscal revenues?
So, GCC sovereigns have embarked on an effort to strengthen their non-hydrocarbon sectors in order to diversify their economy, but also ease the vulnerability of their public and external finances to oil price moves and to generate more private jobs for their citizens. Diversification is proceeding at varying paces across the region and tend to be advancing faster where the business environments are supportive and support from government and GREs is the largest. Development models are often similar. They tend to rely on the import of foreign labor and intellectual property to integrate in global and regional supply chains supported by a low tax environment. They tend to differ depending on the ease of doing business and on the availability of capital to co-fund or to de-risk investment projects. So Saudi Arabia produces a lot of oil, but also has a large and young population and strong social pressures to create more jobs. So it's among the most ambitious in the region. It's using its oil revenue, but also some foreign asset repatriation and a lot of GRE debts to foster the development of large new sectors in the economy. But FDIs have been pretty modest compared to their ambitions, and looking at the need to balance those domestic investment ambitions with the preservation of external buffers, that puts a bit of a constraint on the ability of the state to fund this expansion. In the UAE, which is the most established investment hub in the region, Abu Dhabi is using its oil revenue to push for diversification, mostly through GRAs and trying to attract more foreign investors along with those. Oman does not quite have the same financial flexibility, and they rely more heavily on their favorable geographic location on the ocean side of the Strait of Hormuz and the abundance of renewable potential for industrial activity. Now, if we look at what that means for revenue diversification, there's been a lot of changes in the past 10 years. GCC countries have introduced the VAT since 2018, and several have corporate income tax, and now Oman will be the first one to implement personal income tax, even though it's very limited in scope. So those tax revenue provide some support to the credit profile, but they are and will remain very dependent on hydrocarbons to fund both social and investment spending for the foreseeable future. To give you a sense of scale, hydrocarbon revenue accounted for somewhere between 60 and 75% of revenues for GCC countries in 2024. So even though the non-oil economy is dynamic, given it's an expansion phase, the governments are not that willing to tax it very much.
Okay, thank you, Cedric. So, despite the sort of modest developments that you've spoken about, how vulnerable are GCC sovereigns to changes in oil prices?
All GCC sovereigns are quite vulnerable to changes in oil or gas prices. We estimate that a $10 change in the price of a barrel leads to a change in the budget balance of close to 2% of GDP for Bahrain and Saudi Arabia, close to 3% for Qatar, Abu Dhabi, and Oman, and nearly 5% for Kuwait. So with our base case oil price of $70 per barrel in 2025, Abu Dhabi would retain a funding surplus. Qatar and Oman would be close to balance, while Saudi Arabia, Bahrain, and Kuwait, although at different degrees, different levels, will have net funding needs. With that said, if you look at our headline fiscal metric, which include investment income from the sovereign wealth fund, and this is substantial for Abu Dhabi, Qatar, and Kuwait, those three will retain a general government fiscal surplus at that price level. Looking beyond this year, Abu Dhabi and Qatar stand out in their resilience to a drop in oil prices. Qatar, because more LNG export capacity would be brought online from 2026 onwards, and that will significantly lower the break-even gas price for them. Abu Dhabi is in a somewhat similar position, but with oil, they're the main beneficiaries of higher OPEC plus quotas due to their large spare capacity. Oman does not quite benefit from the same level of hydrocarbon production compared to its need, nor from a potential rise in production, but it's building a fiscal record of prudence. So it's likely to adjust its budget spending if oil revenues drop to limit the deficit. That's in sharp contrast to Bahrain. They have wide and structural budget deficits, and in a lower oil price scenario, we expect that would just accelerate the growth of its already sizable debt burden. Kuwait has made the least progress in terms of revenue diversification and also has significant spending rigidities, but they have large investments income from the sovereign wealth fund, and that means they would still record a fiscal surplus at $60 per barrel. We estimate that the fiscal break-even oil price for Saudi is close to $90 per barrel. And while there's scope for adjustment on the capital spending side, non-oil revenues are small and lower oil prices would lead to higher fiscal deficits.
Thanks, Cedric. How's the region been affected by the recent geopolitical events in the Middle East?
Not very much. The direct impact on GCC sovereigns appears very small. Some closed their airspace for a short period of time at the height of the conflict, and economic activity may have been impacted for a few days. But even the strikes in Qatar do not appear to have had material economic impact. When we look at regional equities, they recovered their losses. PMIs held up and are still in expansionary territory. And tourism data shows that they continue to receive more tourists in the first half of this year. Now, if we look at the Strait of Hormuz, which is a key transit point for GCC oil exports, there were no major disruptions. Oil prices jumped by around $10 per barrel during the Israeli strikes on Iran, but those gains were quickly pared back as the hostilities ceased. We can imagine a more adverse scenario involving a significant broadening of the regional conflicts and maybe disruptions to the Strait of Hormuz. But in such a high risk scenario, there would likely be much higher oil prices, which might benefit the GCC sovereigns. But that's a scenario that we view as very unlikely.
And finally, in terms of ratings, we've got two sovereigns in the region with non-stable outlooks. That's Bahrain and Oman. So what would it take to resolve those outlooks?
So Oman's rating has been an upward trend since 2022, moving from BB minus to BB plus, and since December 24, now with a positive outlook. So that improvement came as a result of fiscal reforms and favorable oil prices, and that resulted in significant deleveraging and substantial improvements to fiscal and external metrics. But Oman's record of fiscal prudence is still short. So we would need to have greater confidence that this new record can be sustained, for example, by maintaining a prudent fiscal stance in a lower oil price environment or enhancing its external buffers. Those factors could lead to an upgrade of the rating. If we look at what could lead to a stabilization of the rating at the current level, we would be looking at, for example, the weakening commitment to fiscal prudence, for example, weaker than expected reaction to lower oil prices that might result in a rising debts. Now, looking at Bahrain, the B plus rating has been on negative outlook since February 2025. And Bahrain's credit profile suffers from its history of wide budget deficits and high debt to GDP. And we expect the budget deficit to remain close to 9% of GDP and debt to rise to beyond 130% of GDP. So, in the absence of strong fiscal consolidation measures, for example, subsidy reform, something that presents a credible path to a stabilization of debt, Bahrain's credit profile will continue to weaken. Maybe important to state here that we believe that GCC support from the rest of the GCC will remain, but there's no clear framework for it. So the form and timing of it is unclear. The rating outlook of Bahrain could be returned to stable if they present a credible path to stabilize government debt, for example, with a new reform plan, maybe in combination with higher oil prices.
Thanks, Cedric, for your insights, and thank you to everyone for listening. For more on Fitch's coverage of GCC sovereigns, please visit Fitch's website, which is fitchratings.com. We hope you can join us for the next edition of Fixed Interests.
Subscribe to Fixed Interests wherever you get your podcasts.